BYD, China's electric vehicle giant, has been rapidly gaining ground on Tesla. In the first quarter of 2025, BYD delivered over 416,000 electric vehicles, significantly outpacing Tesla's 336,000 deliveries. BYD's success is driven by its expanding lineup of competitive models. The BYD Seal directly competes with Tesla's Model 3, while the Atto 3 challenges the Model Y in the compact SUV segment. BYD is rapidly expanding its global footprint with over 40 manufacturing sites and 27 branches worldwide. This expansion is key to challenging Tesla's international dominance. Industry analysts project BYD will overtake Tesla as the leading global battery electric vehicle brand in 2025, capturing nearly 16% of the global market. The company is targeting 800,000 overseas vehicle sales as part of this expansion. With its rapidly expanding product lineup, technological innovations, and aggressive pricing strategy, BYD represents the most significant challenge to Tesla's electric vehicle dominance. Tesla is facing significant financial pressures, highlighted by a concerning 71% decline in net income year-on-year in Q1 2025. Looking at Tesla's income statement, we can see how revenue flows through the business. Recent quarters have shown a troubling compression in profit margins. Tesla's automotive revenue, which had been growing consistently in previous years, is now facing margin pressure. The automotive gross margin has dropped to approximately 12.8%, a multi-year low. This represents a dramatic drop from the previous year's margin of 18.3%, a decline of 30.1% in this crucial financial metric. One major factor contributing to this margin pressure has been Tesla's aggressive price-cutting strategy. Throughout 2024 and into 2025, Tesla has repeatedly reduced prices across its model lineup to maintain market share. Simultaneously, Tesla is facing rising costs for battery materials. While battery prices had been declining for years, recent commodity price increases have reversed this trend, adding cost pressure. These dynamics are affecting Tesla's production economics. While production volumes have increased over time, financial metrics like net income percentage and free cash flow have become less favorable. Several key factors are driving Tesla's financial pressures. These include aggressive pricing strategies, rising material costs, increasing competition, production inefficiencies, and delayed product launches. These financial challenges represent a significant hurdle for Tesla as it attempts to maintain its leadership position in an increasingly competitive electric vehicle market. Tesla's stock market performance has taken a significant downturn in 2025, becoming one of the worst-performing stocks in the S&P 500. The stock has declined by over 43% year-to-date, representing a massive reduction in market capitalization of nearly $400 billion. This represents a dramatic reversal from Tesla's previous market outperformance, where it had consistently outpaced the broader S&P 500 index. Investor confidence has eroded due to several key concerns about Tesla's future prospects. This decline is particularly notable given Tesla's historical volatility. The stock has experienced both dramatic surges and steep declines in the past, but the current downturn reflects deeper structural challenges. The stock market's verdict is clear. There is increasing skepticism about Tesla's ability to maintain its dominance in the rapidly changing electric vehicle landscape. Chinese EV manufacturers have gained a significant advantage through their robust and localized supply chain infrastructure. This allows them to achieve lower production costs and offer more competitive pricing compared to international competitors like Tesla. A key element of China's EV dominance is its battery production infrastructure. China controls approximately 75% of battery cell manufacturing capacity globally, with companies able to source components locally at significantly lower costs. China also dominates the processing of critical raw materials required for EV production. Between 50 to 70% of lithium, cobalt, and rare earth elements needed for electric vehicles are processed in China, creating a significant advantage in the supply chain. Chinese EV manufacturers have invested heavily in advanced manufacturing facilities. These highly automated production lines enable efficient assembly of electric vehicles, further reducing costs through economies of scale and manufacturing innovations. Robotic assembly lines further reduce labor costs in Chinese EV production. Additionally, the geographic proximity between component suppliers and vehicle manufacturers reduces logistics costs by an estimated 10 to 15% compared to international supply chains. This chart illustrates China's remarkable dominance across virtually every stage of the EV supply chain. While mining is more globally distributed, China controls the majority of processing, component manufacturing, and battery cell production, the most value-adding segments of the supply chain. These supply chain advantages translate to significant cost savings for Chinese EV manufacturers. They benefit from 20 to 30% lower battery costs, 15 to 25% lower component procurement costs, 10 to 20% lower labor costs, and 5 to 10% lower regulatory compliance costs compared to international competitors. Due to these comprehensive supply chain advantages, Chinese EV manufacturers can price their vehicles 20 to 40% lower than Tesla while maintaining profitability. This pricing power directly challenges Tesla's market position and is a key factor driving the changing competitive landscape in the global EV market. Chinese EV manufacturers have a significant advantage in their ability to adapt to local market needs. Being based in China gives local manufacturers a deeper understanding of Chinese consumer preferences and cultural nuances. These manufacturers have three key advantages: an intimate understanding of local culture, the ability to respond quickly to market trends, and they can develop features specifically tailored to Chinese consumers. Data shows that Chinese consumers increasingly favor local brands over international ones. The biggest factor is value for money, where local brands have a 39% advantage. Chinese EV makers have capitalized on this trend by offering features that resonate with local consumers at competitive price points. The growing Chinese semiconductor industry illustrates this localization advantage. Domestic production is projected to meet over 20% of China's IC market demand by 2024, supporting the EV supply chain. However, we must be careful not to oversimplify these market dynamics. Foreign brands like Tesla face nuanced challenges beyond just nationalism or patriotic buying. Chinese EV manufacturers implement sophisticated cultural adaptation strategies to gain market advantage. These include creating localized marketing campaigns, developing features that resonate with Chinese consumers, designing region-specific vehicle models, and integrating with China's unique technology ecosystem. In conclusion, Chinese EV manufacturers' deep understanding of the local market and ability to adapt their products accordingly gives them a significant strategic advantage over Tesla. BYD has made significant technological breakthroughs in electric vehicle charging. One of BYD's most impressive innovations is its ultra-fast charging system. BYD's charging technology can deliver 400 kilometers of range in just 5 minutes, significantly outpacing Tesla's supercharger technology. When comparing charging speeds, BYD's system charges nearly twice as fast as Tesla's current supercharger network. This rapid charging capability is transforming how charging stations are being deployed and utilized. The benefits of BYD's ultra-fast charging technology are transformative for electric vehicle adoption. It dramatically reduces charging times, makes long-distance travel practical, and addresses range anxiety, a major concern for consumers considering electric vehicles. With this technological edge, BYD is positioning itself as a leader in solving one of the biggest challenges in electric vehicle adoption. Pricing strategies have emerged as a critical differentiator in the global electric vehicle market. particularly between Tesla and Chinese manufacturers. Let's examine a direct price comparison between Tesla and BYD models. The Tesla Model Y starts at over $52,000, while the comparable BYD Auto 3 is priced at just over $42,000, a difference of nearly $10,000. The pricing advantage of Chinese manufacturers is substantial. BYD's average selling price is approximately $20,000, less than half of Tesla's average of around $45,000. This significant price gap creates tremendous competitive pressure on Tesla's market position. This market positioning chart illustrates how various EV manufacturers are distributed across price and performance segments. Tesla occupies the high-performance, high-price quadrant, while Chinese brands like BYD and Geely offer more affordable options without sacrificing substantial performance. The impact of these pricing strategies is evident in market share data. While Tesla remains the leader in worldwide battery electric vehicle sales, it has experienced a 4.5% year-over-year decline in market share. Meanwhile, Chinese manufacturers like SAIC and BYD are gaining ground rapidly. BYD's pricing strategy is further enhanced by its diverse product lineup. The company offers multiple models across various price segments, allowing it to capture a wider range of consumers. From sedans to SUVs, BYD provides competitive options at each price point. Several key factors enable Chinese manufacturers to maintain their pricing advantage. These include vertical integration of the supply chain, government subsidies, lower production costs, scale economies from China's massive domestic market, and in-house component production, particularly batteries in BYD's case. The head-to-head competition between Chinese and Western EVs is increasingly visible in international markets. Consumers now have real choices between similar vehicles at significantly different price points, forcing Tesla to reconsider its pricing strategy. In conclusion, the substantial price gap between Tesla and Chinese EV makers represents one of Tesla's most significant challenges. BYD and other Chinese manufacturers are offering increasingly comparable quality and features at much lower prices, forcing Tesla to either reduce prices and accept lower margins or risk losing further market share. This pricing advantage may accelerate Chinese manufacturers' global expansion in the coming years. China and the US have vastly different approaches to EV policy. China offers strong government subsidies, imposes EV production quotas on manufacturers, provides tax incentives for consumers, and heavily invests in charging infrastructure. In contrast, the United States has more limited federal incentives, relies on state-level regulations that vary widely, has only recently passed significant climate legislation, and generally takes a less coordinated approach to EV adoption. China has made electric vehicles a national priority in its 5-year plans, investing over $60 billion since 2009. The government has set aggressive targets for EV adoption, aiming for EVs to make up 25% of all vehicle sales by 2025. China has also built over 50,000 charging stations nationwide to support this growth. A key result of China's policies is significantly lower EV prices compared to the US and Europe. While average EV prices have remained high in Western markets, China's combination of subsidies and fierce domestic competition has driven prices down, making EVs more accessible to average consumers. The sources of capital also differ significantly between the two countries. In China, EV manufacturers benefit from government direct funding and subsidies, low-interest loans from state-controlled banks, and municipal funds that provide local incentives for manufacturing. In contrast, U.S. companies rely more heavily on private sources like venture capital, which expects higher returns on shorter timelines, public markets that demand quarterly results, and private equity that typically focuses on later-stage companies. China's policies have led to the development of EV manufacturing hubs across the country. The government strategically supports manufacturers in different regions, creating a nationwide ecosystem of EV production. This regional distribution helps spread economic benefits while building a comprehensive supply chain. The results of China's supportive policies are clear when looking at sales data. In 2022, domestic manufacturer BYD led the Chinese market with 1.9 million vehicles sold, outselling Tesla by more than 4 to 1. Other Chinese brands like Ion, Hosan, and Li Auto have also captured significant market share, demonstrating how policy support has created a thriving domestic EV industry. In summary, China's coordinated policy approach and government funding create significant advantages for domestic EV manufacturers. The long-term planning and stable capital allow Chinese companies to focus on growth rather than quarterly results. U.S. manufacturers face more market-driven pressures and less coordinated support. These policy differences directly impact how competitive companies can be in the global EV market. Facing challenges from Chinese competitors, Tesla has developed a multifaceted strategy to maintain its position. Tesla is implementing aggressive cost reduction measures, including manufacturing efficiency improvements, supply chain optimization, and battery cost reduction. Tesla continues to lead in autonomous driving technology with enhanced autopilot functionality and its full self-driving capability, powered by advanced AI and computer vision systems. Beyond vehicles, Tesla is advancing its energy storage business with Powerwall home batteries, utility-scale megapacks, and integrated solar solutions, creating additional revenue streams. Tesla continues to expand its supercharger network, a key competitive advantage, with faster charging speeds and strategic locations. The company has also begun opening this network to non-Tesla vehicles, creating a new revenue stream. Tesla maintains several key competitive advantages over its Chinese rivals, particularly in its global supercharger network and autonomous driving capabilities. However, Chinese competitors are rapidly closing the gap in battery technology. Tesla is planning to introduce a lower-cost version of its popular Model Y in China. Facing increasing competition from Chinese EV manufacturers, Tesla is under pressure to adapt its pricing strategy in the world's largest electric vehicle market. The company has been losing market share to domestic brands that offer compelling alternatives at more competitive price points. The Model Y currently faces strong competition from both domestic Chinese brands and international manufacturers. Many competitors offer similar features at lower price points, putting pressure on Tesla to respond. Tesla's answer to this challenge is a lower-cost Model Y, internally codenamed Juniper. The company plans to launch this more affordable version in 2026. The goal is to recapture market share in China by offering a more competitively priced vehicle while maintaining Tesla's reputation for quality and technology. However, Tesla's production plans for this lower-cost Model Y have already faced delays. The original timeline has been pushed back due to manufacturing challenges and supply chain considerations. Meanwhile, Chinese competitors continue to advance rapidly, potentially widening the gap before Tesla's new model arrives. The current projected timeline shows Tesla in the development phase throughout 2025, with the expected launch of the lower-cost Model Y in 2026. If successful, the company could expand this model globally in 2027. However, this represents a delay from the original timeline, which targeted a late 2025 launch. The lower-cost Model Y represents a critical element in Tesla's strategy to maintain competitiveness in the Chinese market. While the delays are concerning, the eventual launch could help Tesla regain momentum against increasingly capable domestic competitors. China continues to dominate the global electric vehicle market with unprecedented growth. Projections show China reaching an impressive 12.9 million electric vehicle sales in 2025. This dominance is built on a vast network of manufacturers spread across the country, creating a robust industrial ecosystem. China's advanced manufacturing capabilities have created some of the world's largest and most efficient electric vehicle factories. China currently holds approximately 55% of the global EV market, more than double the share of Europe and nearly 4 times that of the United States. China's dominance extends to charging infrastructure, with the country building out the world's largest network of charging stations. Despite this dominance, China's electric vehicle market is undergoing significant consolidation. Industry analysts predict that by 2030, only a few major companies will control the majority of the market. As Tesla faces mounting challenges, let's examine potential future scenarios if these trends continue. Tesla's stock has experienced significant volatility, with sharp declines signaling investor concerns about the company's future prospects. The overall electric vehicle market is projected to grow substantially, reaching $1.1 trillion by 2030. However, Tesla's share of this expanding market could decline to less than 10%. Tesla's production has shown vulnerability to disruptions, with recent quarters showing declines. Meanwhile, competitors are rapidly scaling up their manufacturing capabilities, potentially further eroding Tesla's position. Looking forward, we can project three potential scenarios for Tesla. In the best case, Tesla maintains around 15% market share by successfully introducing budget-friendly models and preserving its technological advantages. Most likely, Tesla's market share will decline to between 8 and 12%, becoming just one of several major EV manufacturers while facing pressure on profit margins. In the worst-case scenario, Tesla's share could drop below 5% with serious profitability challenges as its technological advantages are eroded by competitors. Tesla's potential decline carries significant implications for the entire EV industry. Increased competition will likely drive innovation and lead to more affordable electric vehicles. We may see market fragmentation across regions, with Chinese manufacturers gaining global influence. However, the pace of autonomous driving development could slow without Tesla's aggressive push. Several critical factors will determine Tesla's future trajectory. Cost competitiveness remains a major weakness, with Chinese competitors maintaining significant pricing advantages. Tesla still leads in technology innovation, particularly in battery technology and software, though this gap is narrowing. Manufacturing efficiency presents ongoing challenges, especially as Tesla attempts global expansion. The Tesla brand remains strong, but is increasingly vulnerable to changing market perceptions. Despite Tesla's potential challenges, the global electric vehicle market will continue its dramatic growth trajectory, reaching over $1 trillion by 2030. The EV revolution will proceed regardless of which companies lead the way. BYD's vertically integrated supply chain gives them a significant competitive advantage in the EV market. Unlike most competitors, BYD controls nearly every aspect of their production process, from raw materials to finished vehicles. This diagram illustrates BYD's comprehensive vertical integration strategy. From mining raw materials to final assembly, BYD maintains control over each critical component. BYD's vertical integration delivers several critical advantages. By controlling costs at every stage, they maintain supply chain stability even during global disruptions. This approach also ensures consistent quality control and accelerates their innovation cycles, as changes can be implemented across the entire production chain. BYD's modern production facilities are highly automated and efficient. This level of automation is possible because BYD designs both the manufacturing equipment and the products themselves. BYD manufactures critical components in-house, like this 8-in-1 power domain controller. While some electronic components are sourced externally, BYD produces the circuit boards and integration systems themselves. This vertical integration strategy has contributed to BYD's impressive production growth. In 2022, BYD outproduced Tesla with over 1.8 million vehicles and achieved a remarkable 211% growth compared to the previous year. Vertical integration also gives BYD complete control over their workforce specialization. Workers are trained specifically for BYD's unique manufacturing processes, increasing efficiency and quality. When comparing BYD and Tesla's approaches, we can see key differences. While Tesla partners with various suppliers, BYD's vertical integration strategy gives them direct control over nearly every aspect of production. This vertically integrated model has become a cornerstone of BYD's success, allowing them to navigate supply challenges while maintaining consistent cost control and quality. Tesla's Shanghai Gigafactory, also known as Giga Shanghai, represents a critical strategic investment for Tesla's expansion in China. The factory is Tesla's first production facility outside the United States. Construction began in January 2019, and remarkably, the first vehicles rolled off the production line by December of the same year. Today, the facility has capacity to produce over 750,000 vehicles annually. Giga Shanghai features state-of-the-art manufacturing technology and produces both Model 3 and Model Y vehicles for the Chinese market and for export to other parts of Asia and Europe. The impact of Giga Shanghai on Tesla's global operations has been enormous. Production and deliveries have consistently grown since 2021, with only a brief disruption in April 2022 due to COVID-19 lockdowns in Shanghai. The Shanghai factory has been essential to Tesla's growing market share in China. As we can see from this data, Tesla's presence in the Chinese market has grown significantly since Giga Shanghai became operational, approaching the levels seen in Europe by 2021. Despite the success of Giga Shanghai, Tesla faces intensifying competition from domestic Chinese brands. BYD has recently overtaken Tesla in global battery electric vehicle sales for 2 consecutive quarters. In March 2025, Tesla held just 7.5% of China's new energy vehicle market, while BYD commanded a dominant 29.3% share. In summary, while Giga Shanghai has been crucial to Tesla's success in China, the company faces mounting pressure from domestic automakers. BYD and other Chinese EV manufacturers continue to gain market share with competitive pricing and rapid technological innovation. This growing competition represents a significant challenge to Tesla's future position in the critical Chinese market. Cox Automotive, a leading automotive research and analytics firm, has observed a significant trend in Tesla's U.S. sales performance. According to their analysis, Tesla's sales in the United States reached their peak in the spring of 2023 and have been declining since that point. This chart shows Tesla's sales pattern. We can clearly identify the peak in early 2023, followed by a notable downward trend. This sales decline has had a direct impact on Tesla's market share position within the electric vehicle segment. When examining Tesla's performance against other manufacturers, Cox Automotive notes that despite overall growth in EV adoption, Tesla's position has weakened relative to competitors. Cox Automotive's analysis highlights several key points regarding Tesla's current market position. Their data shows a clear trend. After peaking in spring 2023, Tesla's sales have experienced a continuous decline, despite the company's efforts to maintain growth through price adjustments and model updates.